Hi, it's Dre Griggs with Obsidian Wisdom. Today we discuss how to make your retirement income last longer. Making your retirement income last longer is all about smart planning, strategic investments, and thoughtful spending. Today we'll discuss a step-by-step approach that you can use to ensure that your retirement income lasts longer. Because when it comes to questions that I get about retirement planning, the most common and number one question that people have is, Dre, do I have enough money for my retirement? This can be asked in a variety of ways. Sometimes we'll ask, when should I take Social Security? Other times we'll say, can I afford to take this trip? But what we're really trying to understand is, do I have enough money for my retirement lifestyle, my healthcare expenses, to help my family? We're really trying to figure out, do I have enough money? And so when you really take a step back and you ask the question, how do I make sure my retirement income lasts longer? There's really three levers that we always discuss. You hear me mention them all the time. One is that I can spend less. Two is that I can make more. And three is I can retire a little bit later. So when you're first talking about how do I spend less, the number one and easiest approach is for us to see where we're spending our money in the first place. When I talk about thoughtful spending, for the most part, that means we need to know where the money goes each month. This is a part of your overall retirement plan, where what we'll do is we'll look at what your lifestyle is. That's what our expenses are. We talk about expenses in a way that I think separates them from the overall joy of retirement, where, oh, I got to get my expenses down. Well, the way I would look at it is, what do I want to do in retirement? What is really important for me in retirement? And where could I possibly make some changes? Sure, we can spend less, but are we enjoying retirement? Right? I could eat ramen noodles every day. I can go back to college and have my ramen noodles and my Easy Mac. But is that what I want in retirement? And I would say no, that's not really the goal of spending less. When we're talking about controlling our spending, it really comes down to listing out the goals that we have for retirement, seeing which ones we're going to prioritize. And this could be something as simple as the things that I need and the things that I want. Make sure all the things that we need are covered. And then we put our wants in a priority and we look at our budget and we say, all right, I have the ability to do 2 or 3 of these every single year. And then we go through retirement knowing what our goals are and allocating our time to be able to do this. When you have a retirement plan, we have a lot more flexibility, where you may say, I want to take a trip to Italy, or I may want to take a trip to Rome, or I want to go with Dre to Nigeria. If we take these trips, okay, if we set them out a year, 2 years ahead of time, that becomes a much simpler approach to managing these expensive trips. Now, a lot of the times what we consider expensive isn't really expensive in the grand scheme of things. For example, we know that most people working in the United States are going to have over $1 million come in and out of their hands over their lifetime. The difference between what we might consider wealthy and rich is how quickly that $1 million comes in and out of your hands. If it takes 20 years to reach the $1 million, well, that feels different than if it took me 10 years, than if it took me 10 months, than if it took me 10 days. It's something that we're all going to get, but it's relative to how much time it takes us to get the money. Your retirement also is relative to the time. We may be able to take that trip to Nigeria if we allocate money for 12 months. We may be able to take that trip to Nigeria if we allocate our money for 24 months. But if you're someone who wants to take this spontaneous trip in 12 days, well, that is going to be a strain on your overall retirement. That's why when I talk about expenses, it's not about just not spending the money. It's simply being more thoughtful about spending the money, having a more intentional approach that these are the goals that I have, and I'm going to spend my money in a smart way that ensures that I can accomplish all of my retirement dreams just in the right timeline. The second way to spend less is spending less on taxes. You and I know that taxes are an expense, that the money I have, if I have to give some of that to Uncle Sam, that is essentially me lowering my monthly income, whether that is my Social Security being taxed, or whether that is my money being allocated in a less than tax efficient manner, where it's being taxed as normal income when it could be taxed at capital gains income, or if we're talking about required minimum distributions creeping in later on in retirement, and I'll put a link to a video where I go through some required minimum distribution strategies. We want to be thinking about taxes because it is an expense. It is lowering the amount of money that we can spend in retirement. And so if we could maintain our overall lifestyle, but spend less on taxes, well, that does the same thing. We're still spending less because I'm paying Uncle Sam less. Versus if I spend less on food, well, yeah, we could technically spend less on food, but if I spend less on taxes, I get the same benefit and I haven't changed my lifestyle at all. Now, for some of you, that might mean that we should be thinking about Roth conversions, where we are doing these backdoor Roths where we take some of our money out of our pre-tax accounts and we start allocating it into tax-free income in retirement. Well, Uncle Sam, most times the nod is going to want you to at least pay taxes once. So as long as we pay taxes when we do the transfer, Uncle Sam will say, sure, put it inside of a Roth, and now you don't have to worry about taxes going forward. These are all approaches that we can do to lower how much we're spending without actually lowering our overall lifestyle. Number 3 on our list is cutting expenses strategically. When you're talking about cutting expenses, we could be saying, I'm going to downsize my home, or I have this mansion and I have 3 floors and I don't like walking up the stairs anyway. All my kids are gone. Maybe it does make sense for me to live in a smaller home. Or we live in an area where we have lots of space and we don't really see anybody, but we want to be able to have some friendships with some neighbors and different things. So this could be an opportunity for us to move. Sometimes we want to move from different states where we're like, I'm in a very expensive state. Your retirement income is taxed differently in some states, where some states won't tax your retirement income and some states won't even tax your Social Security, but there's other states that will. All of these are different approaches that we can take a look at where I'm going to be cutting my expenses strategically. Another approach is I look at my debt, and I'll put a link to another video where I go through some debt management approaches and I get rid of my debt. Again, if I'm able to lower what my monthly expenses are, what we normally call like our break even, where we take all your expenses that you have money going out, and to maintain your lifestyle, that's your break even. That's how much money we have to generate. If we lower what that break even is, where maybe your current lifestyle is $5,000 a month, but we're able to lower it to $3,000 a month by focusing on debt elimination, well, again, we found another way to lower what we spend, make our money last longer in retirement, but we haven't changed our overall lifestyle. You still get the benefit of doing all the things that you want. We simply got rid of some of those inefficiencies of where your money is going. I think most of us can appreciate the idea that if I did not have these old bills to pay, I would have so much more money to put towards other things. The goal is for us to be able to get our freedom of time back. And there's so many approaches that we can use. And so when it comes to lowering how much you spend, you want to be very mindful of these different choices that you have. Number 4 on our list is managing healthcare costs. This is probably going to be one of your top 2 expenses in retirement. So if we're able to get ahead of this, it just helps us as far as lowering some of our expenses. We could be looking at Medicare and we can say, well, based on the amount of time that I'm going to visit the doctor, based on my traveling and my retirement lifestyle, maybe it makes sense for me to get a Medicare supplemental plan to where I have this set monthly fee, and then it kind of eliminates a lot of the uncertainty. So now I could just budget for my set monthly fee where I don't have to pay as much for my deductibles and my copays, and it even opens the door for me to be able to have more things covered than I would in my normal Medicare plan. And for some, the Medicare supplemental plans make a lot of sense. For others, the Medicare Advantage, Medicare Part C makes the most sense for them. There are other ways that we can limit how much we spend in healthcare. And whether you want to look at long-term care insurance as a way to limit how much we might have to spend in retirement, or you want to look at having your health savings account, which, as you guys know, is the triple tax benefit. So it means that the money goes in tax deductible, the money grows tax deferred. As long as you spend the money on healthcare expenses, which we'll all have in retirement, you can take the money out tax-free. Where if we're able to put money inside of our health savings account, I'm able to not only limit how much money I need to pay for my health expenses because I already have a certain amount set aside, I'm able to also lower what my overall taxes are because I'm not paying taxes on this money when I spend it. You could also look at things like your preventative care. So whether you're talking about going to the doctor more regularly, maybe you're talking about going on walks and exercising, maybe you're talking about yoga and stress management, whether you're talking about eating healthier, there are so many things you can do in preventative care. And all of these are ways that will ultimately lower your healthcare expenses, and then it lowers how much you have to spend and how much we have to allocate towards your overall healthcare in retirement. Which leads us nicely into number 5, which is protecting against unforeseen risk. And when I say unforeseen, it's more that we don't know when it's going to happen. It's not that we don't know what's going to happen. So for example, we know that 7 out of 10 people have a long-term care episode, and we know that it's on average to go to a skilled nursing home or physical therapy or to have a home health aide person come to you, that could be anywhere from $45,000 to $55,000 a year. And if we know on average it's about 3 years, that means we should have about $150,000 set aside for that. So we either have the money set aside or we have long-term care insurance. If we have long-term care insurance where we're giving the risk to the insurance company, now we know that that is going to help our money last longer, that I'm not going to have a long-term care episode deplete my overall retirement funds. So now that I have the insurance, I can then allocate my money more aggressively to some investments because I don't have to have it in a relatively safe environment. Now, I will put a link to another video where I go through some of these strategies to ensure that you don't need an emergency fund. But if you don't have a lot of these things set up, then an emergency fund is also a great strategy to ensure that your money lasts longer. And the way I normally look at emergency fund is I would normally couple that with the 3 bucket strategy as far as your withdrawal strategy. And normally that first bucket is going to be your safe investments. It's almost going to be liquid cash. This is 2 years of your living expenses. If you have that set aside, that is essentially your emergency fund. And what it does is it gives me a little bit of an advantage where I can leave my money invested overall aggressively because I have something set up where I have 2 years of runway. The issue that a lot of us have where we have to get very conservative in our investments is because we're pulling the money out to pay for our every month expenses. And because I'm using that money every month, if we end up in a volatile market, then I may be pulling the money out when the stock market is down, locking in my losses, which will then shorten how long my money lasts. The reason that protecting yourself against risk is so important is if we don't have a plan in place, then when I have a long-term care episode, then when I have to go to the doctor and go to physical therapy and I have these different treatments, then all of a sudden it's siphoning out a significant amount of my retirement income and it's shortening how long my money will last. By having any one of these first 5 strategies in place, you can see why spending less will help your money last a little bit longer, but spending less doesn't have to be I spend dramatically less. There are so many ways that we can lower what our retirement expenses are without actually lowering our retirement lifestyle. When you move into the making more portion of how do I make my income last longer, obviously making more is how we make our money last longer. If I have more money than I can spend, then my money will always be there. If I have less money than I need to maintain my lifestyle, then my money is slowly going to be running out. So ultimately, when you're saying making more, we need to normally be diversifying our income streams. As I often mention, studies show that 65% of self-made millionaires have at least 3 streams of income. And when you look at the 7 streams of income that the IRS says that they recognize, we can then decide what makes the most sense. The reason I like investing in the stock market is it gives me access to all 7 streams of income. But you don't have to invest in the stock market if that's not for you. There are 3 asset classes that normally give us access to multiple streams of income. And that's going to be a business, real estate, or the stock market. And the nice thing about these 3 asset classes is the government is going to give you a much more favorable tax treatment. And the reason is our government has really 2 key objectives. Now, we do have lots of incentives built into our tax code. Everything from paying less in taxes if you have children, to being able to write off some of your expenses if you're adopting someone, to planting trees. There are so many things that you can do to lower your overall tax bill. But the 2 main ones are giving people jobs and giving people houses. That if people have a home to live in and a job to go to, the government is very nice to you. And that is why rental income is a much more favorable tax treatment than someone who has earned active income. That is why capital gains is taxed at such a favorable tax rate, because we're investing in businesses that are then going to give people jobs. So Uncle Sam said, as long as you're leaving that for a year and a day, I will give you a much more favorable tax bracket. And you can go down the list, but ultimately, if you're able to just simply look at corporate taxes, I believe the last time I looked at it, it was less than 10% of the government's revenue comes from corporate taxes, that about a quarter of it comes from our individual taxes, and close to 40% of the government's revenue comes from payroll taxes. Now, on the business half of your payroll taxes, they get to write off their 7.5%, because it's a business and you're able to do that. W-2 income earners, they pay their 7.5% towards the payroll taxes, but they don't get to write it off because they're an individual. So when I'm talking about multiple streams of income, even if you just go from an apples to apples perspective, where I'm just simply saying I'm going to get $100,000 in rental income, or $100,000 from a business profits, or $100,000 for earned active income, it is going to be much more beneficial for you to have your income streams from rental income and profits from a business than it is from earned active income. Now, the beautiful thing is, if we diversify our income streams, these other streams outside of earned active income is what we're really looking for when we plan on retiring. We don't want our money from earned active income because that means I always have to work for my money. And you want to be able to get to a place where even if they called you up when you retire and they said, hey, I will give you twice your normal salary, please come in and help us. You'll be able to laugh at the idea and say, my time is not for sale. I am not for sale. I have purchased all of my time back. I am free from having to trade my time for money, so I'm not interested in it. Now, if you are, then that's great. Get paid double for what you've always done. You do have the wisdom and the skill set, but if you don't want to do that, you don't have to do that. And that is something that you've earned over the years and is definitely something that you should enjoy in your retirement. Now, I do know for some people, especially in this gig economy, where they'll have part-time work. And they'll have part-time work for a variety of reasons, and it's not always because they want the additional income stream. Some like the relationship, some like just getting out of the house, some like helping people, some they're able to do a passion project and they simply get paid part-time. Others I know have the part-time income because they want to have the health insurance that's tied to that particular job. There are a variety of reasons, but part-time income is an income stream where you can make more and that will help your money last longer. Even if that means you retire from your main role in corporate America and then you just work part-time, almost partially retired, where you have a lot more of your time, where you used to work 40 to 60 hours a week, and now you work 15 to 25 hours a week. Well, that part-time work still gives you back about 30 hours every single week that you now get to decide what you want to do. And for many people, that little bridgeway between their full retirement and fully working, they enjoy that partially retired. They're able to start trying things out, figure out what brings them joy with their time. And that, as a result, gives them a little bit of an idea when I'm fully retired, everything I'm going to do, where they hit the ground running when they're fully retired because they've gone to a lot of hobbies, they joined a lot of groups, they tried a lot of different things. And now they're able to say, okay, I know what my ideal retirement looks like. I have seen it on the other end where someone said, well, you know what, Dre, I actually think I enjoyed working a little bit more and I would rather get paid my full income than the part-time income. That is also an option that's available for you when we talk about making more money. Number 8 on our list is rebalancing your portfolio. Ideally, we design a portfolio that is optimized for the amount of money that you need for retirement. As a result, we should be rebalancing our portfolio periodically to ensure that we maintain that ideal strategy. Because what ends up happening is a portion of our portfolio may be outperforming other parts. And so all of a sudden, the allocation that we set is no longer the one that works for you. We need to go back in and rebalance your portfolio, which is a very fancy way of saying that we're going to go in there and the things that are winning, we're going to sell them, which means we're selling high. And then we're going to buy the things that are losing currently, which is what most people want in their overall investment strategy. But because we don't have the allocation strategy in place, it is very hard for us to actually go and sell stocks that are winning. And it's even harder for us to go and buy stocks that are losing. But if we're simply maintaining an allocation that we already know is going to average the return over its life that we're looking for, then we will feel more comfortable pulling the trigger and taking that approach. The other way that we look at rebalancing is just as we get older, we do need to make adjustments. That the allocation I had when I was 30 is not the allocation I should have when I'm 60. That I have a different focus in my life. That the allocation you had off of 2 incomes and married is not the allocation that you should have off of 1 income and single or divorced or someone passed. That if our life is changing, then our allocation should change with it. And I'll put a link to another video where I go through 3 rebalancing strategies to ensure that we're taking the emotions out of investing and maximizing what our overall returns are. And that leads us very nicely into our third lever to ensure that our retirement income lasts longer, and that is retire later. When we talk about retiring later, we really should take a step back and look at a couple things. Number 1 is obviously, do I enjoy the work that I'm doing? If I enjoy the work that I'm doing, it's not stressing me out, and it's something that I can do, then waiting another year for retirement will exponentially increase how much you have in your fund. You've seen a lot of those little sloping charts, and I'll probably put one up for you, where you can see that for most companies, Amazon and Berkshire Hathaway and a lot of different investments, where it's basically flat and it's slowly going up, and then at some point it exponentially increases. You're in those exponentially increasing years of your retirement fund, where you started investing in those funds 5, 10, 25 years ago, and now your money is growing a lot. The way I would describe it is if you've ever paid off a car or a house, you know that when you first were paying the bills, that your overall balance did not decrease much, that the majority of the money was going towards interest. But then in the last year, you notice that almost every payment, almost all of the money went towards principal, where you were paying down your bills significantly in a much shorter amount of time because you had that avalanche, you had that benefit of being able to say, I've been paying this for 5 years, all the interest is paid off, now my money is working most efficiently. That is the same with your investments. Early on, we're basically laying the runway of our investment strategy, but if you've been following that strategy for 10, 20, 30 years, every time you put money in, every time you look at it, you're like, wow, my money's really working for me. Where you talk about investing $5 a day and how someone could have $1 million in 30 years, well, that's true because that's how efficient your money is operating. which means that if I work one more year where I have my bills paid off, where now I can put 50% of my paycheck towards my investments, not only do I get the benefit of having more money invested, I get the benefit of not having to withdraw my money, that my money is continuing to grow because I didn't retire this year. I get the benefit of being able to do Roth conversions where I have one more year to put this plan in place to make sure my money lasts longer. And my 10th and final thought on retiring later is going to revolve around the idea of Social Security, when I should take it. Sure, we can just say, hey, Social Security increases a lot if you take it at 70, but that depends on a variety of factors. Number one is, do I need the money now? Because if I do, who cares what happens at 70? Number two is our overall life expectancy. Does our family history show longevity, that everybody is like 90 to 105 or something? Or does our family history show something else, where it might not make sense for me to wait till 70 because the break-even point of waiting, which is just the opportunity cost of not taking the money at 62, but allowing it to increase, normally that's going to take about 10 years. So if you don't plan on being retired at 80 years old, then it normally makes sense for you to take the money earlier. But instead of 62, could it possibly be your full retirement age of 67 for most of you? If 67 is an option, then maybe we can wait till then. It really comes down to a variety of factors, such as where my money is currently located. If all my money is in a pre-tax account, I don't know if I want to turn on Social Security, which I can't turn off, and then I have the required minimum distributions, which I can't turn off, and then I might have a pension income, or even we may have a reverse mortgage, where I have these income streams that are very difficult, if not impossible, for me to turn off, to where I move myself into a much higher tax bracket because I have all these income streams going. But if I'm able to delay my Social Security, that might give me the ability to put all my eggs in the right baskets, where I have everything set up in a way that's very beneficial for me and my long-term retirement prospects. Whether I'm looking at creating generational wealth, whether I'm looking at limiting what my taxes are, if I'm able to use those years, those last years, to either put more in my investments, to pay off debt, or to limit my taxes, this is a great time for us to delay retirement because we're able to take a look at the plan. And then normally we'll look at reevaluating your plan on a regular basis. If your life situation changes, then we should look at whether it still makes sense to retire on the year that we set previously. Because when we reevaluate your plan, it's not always a question about whether we should retire later. Sometimes it's a question about whether we can retire sooner. That maybe some circumstances has changed, maybe got an inheritance, who knows what could have happened. But if we checked off all the boxes, then we can retire earlier. Why not? Again, this is your plan, so it adjusts with you and your overall needs and goals. Hopefully you've seen the benefit of having smart planning, strategic investments, and a thoughtful spending gives the ability to ensure that your retirement income lasts as long, if not longer than you do, so that you can maintain your retirement lifestyle, enjoy yourself every single day, and never have to be worrying about, will I run out of money in retirement? If you found value in this video, I simply ask for you to like and subscribe so you can continue receiving valuable insights on how to create your own wealthy retirement system. Until next time, stay safe and enjoy life.